A very good afternoon to you all, friends. I'm Sanjeev Singhal, Central Council member and Vice Chairman Committee for Member in Industry and Business. Uh, I welcome you all to our webinar on Union Budget 2024. Along with me is my very worthy Chairman Dheeraj Bhai Khandelwal from Mumbai. The two speakers for the day, CA Naveen Wadhwa, who does extensive research on the matters of taxation, accounting and finance, CA Karishma Malhan, and we have two very esteemed moderators, CA Kapil Kedar, who's been a colleague earlier, and CA Anushri Garg. I thank the CMIB office also for organizing this program. Friends, the Union Budget 2024 was presented yesterday by the Honorable Finance Minister, and there are several changes which have taken place in the direct taxes and the indirect taxes. On the economy front, the finance minister has laid emphasis on the 9 priorities, and there's been a huge focus on the employment creation. There's also a discussion on creating 1,000 internship in the top 500 companies with a minimum stipend of 5,000 rupees per month, plus a one-time amount of 6,000. There's a lot of focus on the rural development. There's a lot of focus on the development of some of the states on developing infrastructure. There's a focus on the sustainability also. As far as GST is concerned, there have been some changes, although the GST changes are primarily led by the GST Council. There's a custom duty change on gold and some of the other precious metal, which has led to a significant drop in the prices of these precious metals. On the direct tax side, there's a focus on the fact that let the taxpayer adopt a new tax regime. It was mentioned by the Honorable Finance Minister that more than 2/3 of the individual taxpayer have adopted the new tax regime, and 58% of the corporates are following the new tax regime. There is a minor additional exemption which is given under the new tax regime. The 5% slab has been increased up to 7 lakhs. Earlier it was 6 lakhs. So there'll be a benefit of 5,000 rupees. Similarly, this 10% slab has been extended from 9 lakhs to 10 lakhs. So again, there'll be a 5% benefit. So overall, there'll be a 10,000 rupees tax benefit for people having taxable income of 10,000 rupees. And if they happen to be salaried employee, they get an additional standard deduction of 25,000. So these are, and of course, there'll be a cess of 4%. So the individual taxpayer will get some relief under the new tax regime. But significant changes have been made in the way the capital gains are taxed, be it the short-term capital gain, where there's a tax rate has been increased. In the long-term capital gain, the tax rate has been increased. The concept of indexation has gone away. So there are major changes. And of course, some of these changes affect the industry also. Since our committee is a committee for member in industry and business, we thought that it will be appropriate that we organize a program which focuses on the implication of the union budget for the industry. And I thank the office for organizing this program and the very esteemed speaker and moderator for taking out time. With this, may I now invite Dheeraj Bhai Khandelwal for his opening remarks. Thank you.
Thank you, Sanjeev Bhai. I think you are the first person who suggested us to have this budget analysis in terms of industry perspective. So I think it's a good thought to have it, and we immediately acted on it. And thankful to the all faculty over here, speaker, who are going to analyze with the terms of the industry perspective. If we are talking about the industry perspective, I think this budget has given lots for the industries, though which is not being highlighted. The negative being highlighted, the things given for the industries or SMEs. People are talking about some Bihar and Andhra Pradesh, but I think a lot of expenditure is going to be happen in this particular budget, and which is going to be done to the industries like infrastructure sectors. Going to be a big boom for this particular in this budget. And if I talk about the MSME, and in the morning also I was discussing to the all the people like digital footprints trade and assessments for the MSME, which is a welcome move by the governments, and which was depending on a lot of fintechs. Now the governments himself wanted to be have the credit assessment on the digital infrastructure. That is an important aspect which is there in the budget. And another aspect for the industry perspective is that supply chain finance, which is being covered now 250 crore rupees. Buyers having the turnover to more than more than 250 crore rupees can be covered in the trades, and it's a big relief for the the industries or the MSMEs get the funding in these aspects. Another important aspect is that which the government of India has mentioned about the term loan guarantee scheme, credit guarantee scheme for the term loan of up to 100 rupees and even more. I don't know why it is mentioned of the MSME, because if the investment in MSME till definition 50 crores, then it's not for the MSME. Now the government of India itself, the finance minister has mentioned about 100 crore rupees loan on the term loan. That means for the industry specific, I think they are talking about. Or maybe they can increase the definition of the investment in the MSME sector from 50 crore to 100 crore. That's why maybe heard these aspects. I feel that industry perspective, it's a shipping industry is going to be who's beneficial for this particular rental housing is another PP models which they suggested, which also going to be beneficial. Industrial park, 12 industrial park in the near about 100 cities they're going to be have it. Again, it's a boost for the infrastructure sector. One of the important aspect which I can see, it's about the critical mineral assets in the terms of technology which they provided. That's will boost the all input of the many various critical minerals which can be there, and that's industry also can be beneficial with the lower rate of the VCDs. Otherwise, the VCD was higher. Now it's a lower VCDs, 2% is proposed, so minerals can be be cost effective, and that's been finalized for the final product also. Another, I feel that lot of term, lot of ease of doing business they did for the businessmen, like LLPs, voluntary closure of this LLPs. That's also been be there. In IBC, there's a lot of technology platform they're providing. Solar power energy, which is in the interim budget they provided. This again been mentioned over here, rooftop solar for households. So that's again boost of the infrastructure sector. And like that, a lot of things been there even in the tourism also. So I feel this is a good project for the industry's perspective. A lot of custom duty being reduced to have more export of the goods from India to outside India, more competitiveness like textile sector, like leather sector. I think it's been defined with having the competitiveness with the Bangladesh and Vietnam, so that we can have the competitiveness. So I think a lot of things are there. So let's discuss with the things with our speaker, those are over here like Kapil and Karisma and other people, so that we can analyze each industry segment wise how industry going to impact and what is the beneficial, how they can increase their business, how chartered accountant can helpful in each area of the segment for growth of the industries. So these are the segment which we can not only in terms of the individual tax rate or GST or income tax rates, which is our domain area. We do understand this area very well. Not need to define any analysis for it, but definitely in terms of the sector where the tech sector is going to grow, how the sector will grow. This is the first time which we are organizing, and let's keep the finger crossed and understand all the nuances and sector specific things, so that people can be in a ownership or entrepreneur and can work on in this area. So with this, thankful for all the speaker over here, and again give this note to the our coordinators. As Anusri Gupta and as well as the Naveen and all the other people. So thankful for them, and hopefully they will take forward all the questions going to be raised by the participants, and we can have other question also. So over to the Sanjeev bhai and other team. Yeah.
Yeah, thanks, Dheeraj ji, for the wonderful remarks about the budget and the opening session. And thanks, Sanjeev ji, Dr. Sanjeev Singhal, for giving me the opportunity to be moderator for today's event. And my thanks to the learned team of CMI and B, Committee for Members in Industry and Business. So I'll introduce our first speaker for the today's event, CA Naveen Vadhwa. Naveen is a seasoned expert with a wide range of skills, specializing in income tax, international tax, technical product development. He is currently heading the Taxman's Research and Advisory Division. And in this role, he spearheads the efforts to deliver cutting-edge digital content and innovative tech products. Under his guidance, his division takes on the challenge of simplifying complex tax laws and initiating new endeavors that empower business. And he has extensive experience of working with diversified industries like real estate, technology, publication, education sector, etc. He's a chartered accountant, has got 24th rank in his CA, and he has a 15 plus years of experience in income tax and international taxation, with 12 years of experience in technical product development. So Naveen is our first speaker for today's session, and I'll, without taking any further time now, I will request Naveen to start the session to help us decode the complex provisions of Modi government 3.0 first budget and help us understand those complex provisions in a simplified way for the benefit of members in industry and business. Thanks everyone, and over to you, Naveen.
Thank you, Kapil ji. So Sanjeev ji, Kapil ji, and my co-panelist Jitendra ji, and all the guests and friends. So I welcome you all in today's webinar, wherein I'll be talking about the income tax proposals made in the Finance Number 2 Bill 2024, and my colleague shall be talking about the indirect tax proposals. So before I start, I just quickly want to share my screen. I need confirmation if my screen is visible.
Yes, visible. It's visible, Naveen.
Yeah, all right. So for next 45 minutes, I'll be talking about the income tax proposals, and the last 1 hour, Karishma would speak about the indirect tax proposals. The 45 minutes would be very less to talk about all the proposals, but we have covered everything in this PPT, which you can refer to subsequently to understand I won't say the implication, but to understand what are the changes proposed by the Finance Number 2 Bill 2024. So the first, I'll start with the tax rates. There is no change in the tax rates for the individual under the old tax regime. And the way the government is going, I believe this old tax regime would sooner be called as ancient tax regime, because the entire focus is on the new tax regime, and there are many proposals have been made for the new tax regime, and we have been witnessing this from the last 2 years. Every year, there are a lot of proposals for the new tax regime and nothing on the old tax regime. And to some extent, it goes with the government plan to reduce this complex structure of the deductions and exemption. And everybody should have a simple structure of the taxation so that it becomes easy for them to file the return of income to compute the taxable income. So to continue the ritual, they have done few changes in the new tax regime. They have given 1 lakh additional income in the slab rate, the second and the third slab rate. That means up to 7 lakh rupees, your income won't be taxable. Earlier it was 6 lakhs. In the next slab, it would be 10 lakh now. Earlier it was 9 lakh, and it would be taxable at the rate of 10%. So these are the change in the tax rates. Another change in the tax rate is in the case of foreign company, which were used to be taxed at 40%. Now they'll be taxable at the rate of 35%. So these are the two changes in the tax rates. Coming to the next point, which is deductions and exemptions. So the first point is the standard deduction, raising it from 50,000 to 75,000. Again, this benefit would be available only to those salaried individuals who are opting for the new tax regime, nothing for the old tax regime. For them, it would remain at 50,000 rupees. In case of the family pension, the family which gets after the demise of the salaried person, earlier they were getting 15,000 rupees as the, I would call the standard deduction. Now it would be 25,000, but will be available only in the case of new tax regime. Now the third one is, so every employer, so now these days employees are taking the benefit of the NPS, wherein they require their employer to make a contribution to the NPS. Earlier, this limit was 10%, but now this limit has been raised to 14%. But there was a mismatch in the deduction that was allowed to the employer under Section 36(1) IVA, which was still 10% in the case of central government employer. But now this limit has been increased to 14%. we used to send many recommendations to the government wherein we highlight the gaps in the income tax law, and this was one of the recommendation which we sent to the income tax department, the North Block, wherein we highlighted this gap that this 10% limit should be increased to 14% to bring the provision in synchronization with 80CCD, and they have done that this time. Now, coming to the next point, one more institution has been added for the deduction under Section 80G, which is National Sports Development Fund. Two more benefits have been extended to IFSCs, units established in IFSC, which is basically retail funds and exchange traded funds. Similarly, they have covered the recognized clearing corporation for 1023 FE exemptions. So these two provisions do not have much analysis to talk about. So I'm just skipping these provisions. Coming to the Section 68. In Section 68, basically, Section 68 levy tax on you if there are some unexplained source of funds in the form of investment. And by the Finance Act 2023, they have given the exemption to the regulated entities, which were basically the venture capital fund and the venture capital company registered with the SEBI. And you know that as of now, IFSCA is also an independent authority, just like SEBI. So if a venture capital fund is registered with the IFSCA, they are also now out of the ambit of Section 68. Coming to the next point, which is business and profession. So in business and profession, they have introduced a new presumptive scheme under Section 44BBC. This presumptive scheme is for the non-resident companies which are operating the cruise ships. And there is a consequential amendment in Section 44B, means those shipping company will not be eligible to claim the presumptive tax scheme under Section 44B, and now they'll have to pay tax under Section 44BBC at the rate of the 20%. There's also a change in the exemption section of Section 10, Clause 15B, wherein if the paying company, which is taking the 44BBC, paying any lease rental to the owner shipping company, and both the entities are the subsidiary of a holding company, then there would be a complete exemption to the recipient company. So that this is an extension of 44BBC. Now coming to the next point, which is the taxation of the taxable income of the insurance company. So as of now, there is a special tax regime for the insurance company wherein their income is computed based on the actual valuation. And this calculation is done as per Rule 44, Rule 2 of the first schedule. And now what they have done, this time they have made an amendment in the Rule 2 of the first schedule. And why this amendment has been done and what that amendment says. Since, as I mentioned, the income of a life insurance company is computed based on the actual valuation, which is basically on an average basis. So now what this life insurance company used to do, and that's what the memorandum says, they used to claim certain expenditure which are not related to the business or which are the capital expenditure or sometimes are prohibited by various acts. So they used to include those expenditure while computing the taxable income. So now what they have done, they have given a reference of Section 37. If any expenditure is not admissible under Section 37, then that expenditure shall be added back to the taxable income of the life insurance companies. There is one more change in Section 37(1), and from last 3-4 years, the government has been amending Section 37(1) back to back, and they wanted to disallow the deduction for any expenditure which is prohibited by law or which is not allowable, should not be allowable under any law. And so there could be a situation wherein your expenditure, there's a legal suit against you, and you went into a legal settlement and you paid some damages or some charges to the party. So 37(1) has been amended, and now it says that expenditure will not be allowed as a deduction under Section 37(1). So that's the another amendment in Section 37. Now coming to the next point, which is the partner's remuneration. Since ages, this limit were not revised. Earlier, it says if there is a loss of the partnership firm or there is a book profit of up to 3 lakh rupees, the limit was 1.5 lakh rupees in the case of a loss. And in case of a gain, up to 3 lakh rupees of the book profit, you could pay 1.5 lakh or 90% of the book profit as a partner's remuneration. Now, this time, this limit has been raised. So it says up to 6 lakh rupees of the book profit, or in the case of loss, you could pay 3 lakh rupees or 90% of the book profit, whichever is higher as a partner's remuneration. So these are the simple provisions. Now coming to the next point, which is section 28. This is very, very important amendment. An explanation has been inserted in section 28, 28 of the Income Tax Act that says any rental income from a residential house property. So I didn't say house property, I said residential house property will be taxable under the head of income from house property, not under the head of business, profit and gains of business and profession. So there are n number of judgments wherein the courts and the tribunals have evaluated if some income is being earned from letting out of a property, that income could be taxed under the head of the income from the house property or the business income, depending on the circumstances of the each case. So just giving you a few examples, the rental income, the factory building or the warehouses, they were held to be taxable under the head of PGBP. But now after this explanation, they have sorted this controversy. Now it says that your income from the residential house property will be taxable under the head of income from house property, not under the head of PGBP. So now it gives you two impression. Will it solve the controversy once and for all? I believe yes, on the both side. Why I say on the both side? So let's say there is a residential house property and you let it out to your employees. Now it will be taxable under the head of house property. It doesn't matter whether letting out of those house property to your employees or maybe to your contractor was incidental to your business. It will continue to be taxable under the head of house property. But now, in the case of commercial property, the explanation does not mention anything about it. It remains silent on the treatment of the letting out of the commercial property. So I would take an opinion that this explanation settles that controversy too, wherein the rental income from the commercial property should now be taxable under the head of profit of and gains of business and profession. Because if the legislature wanted to cover both the rental income under the head of house property, they should not have used the word residential house property. Simply they could write house property or immovable property. So I believe that controversy has been ended, wherein the residential house property should be covered under the head of house property and your commercial property should be covered under the head of profit and gains of business and profession. In case of a property which you are using to give the services, there has never been a controversy. The income from that property, which may look like a rental income, will continue to be taxable under the head of PGBP. Now the capital gain. So I wanted to reserve my time to talk more about the capital gain. This is the most critical one, and I believe this is in many years, this is the first time wherein the changes which have been made to the Income Tax Act would impact a lot of taxpayers, because be it you're a salary taxpayer or you're a trader, and we see how many the growth of the investment in the stock market. Around we have got 12 crore demat account holders, and the change which has been made to the capital gain provisions will impact a lot of the investors. Right. So now let's talk about the changes in the capital gain provisions. Now, whatever you know about the taxation of the capital gain, so first you need to unlearn everything you know about it, and then you need to relearn everything in this session. So earlier we used to have a lot of confusion on the period of holding, on the tax rate. We have 12 months, 24 months, 36 months. Again, there were a lot of exception for the indexation benefit. Then there were a tax rate of 15%, 20%, 30%. Now everything has been erased. Now everything has been rewritten, and they have given a very simple thing. For discussion purposes, I am saying simple, but believe me, for every case your client has, for every circumstances you come across, you'll have to do a calculation. And that calculation is not to choose the regime which is better for you, but to actually understand if this scheme is better for you or not, right? Because your client may come to you crying that this change has impacted them severely, but believe me, this is not the case in every situation. So let's understand what are the changes, and let's understand how it is really going to impact your tax liability. So now there would be just two holding period, which is 12 months and 24 months. The 12 months holding period will apply to the listed securities, including equity-oriented funds, units of business trust, and zero coupon bonds. And these three securities which I just mentioned could be listed as well as unlisted. So for listed securities, equity-oriented funds, units of business trust, and zero coupon bonds, I know many of them can't be unlisted as per the SEBI regulation, but I am just highlighting if there could be a situation wherein a zero coupon bond is unlisted. In this situation, the 12-month period shall apply to determine if it's a long-term or a short-term. And for all other assets, it shall be 24 months, whether it's a gold ETF, whether it is an emerald property, it is gold or any other capital asset, it will be considered as a long-term capital asset if you hold them for more than 24 months. The short-term capital gain under section 111A will be now 20% instead of 15%. For all other short-term capital gain will be taxable as per your applicable tax rate, right? So if you earn short-term capital gain from sale of gold, immovable property, or any let's say zero coupon bond, so everything would be taxable at the rate of 20 applicable tax rate, not at the rate of 20%. The indexation benefit has gone. Now it's been history wherein we used to check the cost inflation index. We used to wait for April month. We used to guide our client to wait till 1st April before you sell your share to get the additional indexation benefit. Now everything has gone. No indexation benefit at all, and they have taken away the indexation benefit, and in lieu of that they have reduced the capital gain tax rate, which is now 12.5%. Earlier we had 10% and the 20%. So for section 112A, 112, and for every other section, now it would be taxable at the rate of 12.5%, except in the case of special tax rate, like in the case of 50AA specified mutual fund or the VDAs. So those would be taxable as per the special provision which are there in the special tax provisions. Now coming to the next point, which is 50AA, Finance Act 2023 introduced this new section to levy tax on the market-linked debentures and the specified mutual funds. They have made two changes in 50AA. One, they have included the unlisted debentures and unlisted bonds within the scope of 50AA. That means whatever capital gains you earn from these bonds and debentures would not be taxable as per the applicable tax rate, means the short-term capital gain, which would be the applicable tax rate. The another change in section 50AA, which is very, very huge. In fact, I have written a few articles on it. Earlier, there was the 50AA used to say your those bonds, those instruments would be covered in section 50AA, which are the specified mutual fund, which invested up to 35%, rather less than 35% in the equity instruments. But now they have changed it entirely. Now they are saying that 65% of your total proceeds should be invested in the debt and the money market instruments. So this has got very huge implication. So just to give you an example, there are a lot of ETF listed in the Nasdaq wherein you can make investment. Earlier, rather I would say until this amendment comes into the force, your income, your capital gain which you earn by selling the Nasdaq ETF or the gold mutual fund or the gold ETF were taxable under section 50AA as per the applicable tax rate. But now, if you sell these Nasdaq ETF or the gold mutual fund, would now be taxable under section 112 at the rate of 12.5% if it's a long term. If it's a short term, if you held them for less than 12 to 24 months, then it will be taxable as per the applicable tax rate. So that it has got very huge implications. So I invest a lot of money in the US stock market, and it has always been a worry for me, should I sell it or not, because the 30% is very huge amount. So now it would be easy for me to hold it for 24 months and then pay tax at the rate of 12.5%. So this is very important for you to advise your client who makes investment in the US stock market or in the gold mutual fund or the gold ETF in India. Now coming to the next point, which is 112A. Earlier, up to 1 lakh rupees of the long-term capital gain taxation under section 112A, which covered equity shares, units of equity-oriented funds, and the units of the business trust, were exempt from tax up to 1 lakh rupees. Now this limit has been increased to 1.25 lakh rupees. So this is this, and if I combine it with the increase in tax rate, that is 12.5%. So if you're a small investor making investment up to 10 lakh rupees, and assuming you double your investment in the subsequent year, so it is not going to impact you at all, because 1.25 lakh rupees would be anyways exempt from tax. Now coming to the next point, which is the capital gains, again, section 47. So section 47 covers the transaction which are not considered as transfer for the taxability under the head of capital gain. There is a clause, the triple I, which says any gift, any transfer of a capital asset under a gift or a will or by way of irrevocable trust to anyone will not be considered as transfer. So this clause was used for tax evasion purposes. In fact, the memorandum has mentioned it. Any, because generally the gift can be given out of love and an affection, and that this factor is missing in the case of a company. A company cannot give any gift to anybody else out of love and affection. So and that transfer was not taxable in the hands of the donor company, and there are a lot of tribunal in the High Court judgment wherein they have given the benefit of 47 triple I to the company and said this won't be taxable in the hands of the donor company. But now this clause has been amended completely. Now it says this clause will be applicable only if the capital is transferred under a gift or a will or irrevocable trust by an individual or an HUF only. So that means it will not be taxable. It will not be taxable in the hands of the donor. There is no change in section 56(2)(x). That means the recipient would continue to be taxable as per the applicable provision. And so now taking example, so let's say the wedding of a famous personality is the talk of the town. So let's say the company gives some shares or some capital asset as a gift to the groom, and it was not taxable in the hands of the donor company earlier, but now it would be taxable even if the marriage got concluded before the day of the budget, because this amendment is applicable from the assessment year 25-26. That means any gift of the capital asset on or after 1st April 2024 will continue to be taxable, covered by section 47 triple I. That means the donor company will be considered as transfer of the capital asset, and they will pay the capital gain tax on that gift. However, the recipient, groom or the bride will not be taxable if these assets are given on the occasion of the marriage, right? Now coming to the next point, which is the buyback of shares. Buyback of shares, this is again one of the recommendation which we have covered in our list of recommendation, but unfortunately the way we have recommended it, the department didn't accept it in the same manner, and they have made I would say very biggest mistake, or it has impacted the shareholders very severely. And why it is so? So let's understand what this 222F says. So they have inserted one more sub clause in section 2 clause 22, which is basically deemed dividend. So this sub clause F says in the case of the buyback of the shares, any amount, it's not says the differential amount or the excess amount of the amount paid by the shareholder, any amount paid by the company to the shareholder will be taxable as a deemed dividend under section 222 subclause F. So that means your income, dividend income, will be taxable at the applicable tax rate. And otherwise, so earlier, before this section came into force, we had 115 QA to QC, wherein the tax rate was 23.296%, which was pretty less. But the way they have done it now, your cost of acquisition will now be taxable as per the applicable tax rate. But yes, you can claim the cost of acquisition as your capital loss, which you can set it off against your long-term or short-term capital gain, depending on the nature of the income and as per the existing provision. So what does that mean? So let's say, just take an example. You invested 1 lakh rupees in a listed company, and they have done the buyback, and you have given all your shares in the buyback. So now you pay deemed dividend under section 222 on entire 1 lakh rupees. So let's say you are in the 30% tax bracket. So that means you will be paying 30,000 rupees as a deemed dividend tax, and you bought those shares, let's say 90,000 rupees, just for calculation purposes, we are assuming it. So now that 90,000 rupees would be your short-term or the long-term capital loss, which you can set it off against other long-term or the short-term capital gain. That means you can save tax up to 12.5% or the 20%. So on the one hand, the government has taken 30% out of your pocket, but on the other hand, they have given you just 12.5% or the 20%. So I would say this was not expected, and the way they have done it, I would say it goes against the basic principle of the taxation. Now coming to the second point, which is section 55 to close AC. This is relating to section 112A, which they introduced in the year 2018, wherein so earlier there was a problem wherein if you have given your shares in the IPO and you couldn't fulfill the requirement of paying the security transaction tax at the time of acquisition. So to solve that problem, the government has issued a notification wherein they have given the exemption from the applicability of the condition of payment of STT at the time of the acquisition of share to claim the grandfathering provision of 112. And now, but there were a problem wherein the cost of acquisition, there was no mechanism how to compute the cost of acquisition. And in absence of it, the shareholder were taking a stand that this income will not be taxable at all in the absence of a computation provision. So now this problem has been sorted, wherein they have included the computation mechanism of the cost of acquisition. And now it will be taxable. There won't be any exemption anymore. Charitable and the religious trust. So this is again one of our recommendation. We have been recommending from last 2-3 years, wherein we wanted, because the charitable trust, I believe, is one of the most complex tax scheme, wherein the tax scheme are anyways very complex. Now we have got two schemes, one for the approval scheme and one for the registered scheme. For the approval scheme, we have section 1023C, and for the registration, we have 11 to 13. And in last couple of years, they have made substantial changes in both the schemes, and they have made them almost similar. But now they have merged them together, and I believe it will solve a lot of problem. There would be just one scheme, and there won't be any confusion on should I go with 1023C or 1113. And this problem used to arise a lot in the case of educational and the medical institutions. Now they have merged them. Coming to the next point, earlier there were no specific power, specific authority mentioned in the provision who would be the specific authority to apply for the condonation of delay in the filing of registration. We used to file the application under section 119. Now they have appointed principal commissioner and the commissioner for condonation of delay in filing of registration application. The another point is the extension of the limitation period. So the limitation period remains the same, which is 6 months, but earlier it was from the end of the month in which the application was received by the principal commissioner income tax or the commissioner income tax. But now they have changed it to the end of the quarter in which the application was received. They have introduced one more section of 12AC, wherein they have, and this merger is a very common thing in various registered trust. So one smaller trust sometimes gets merged with the bigger trust, and it becomes easy for them to manage their objective. And so earlier there were limitation and implication of exit tax. Now they have introduced a new section 12AC, wherein they have allowed the merger of the approved or the registered charitable trust with the another trust, provided the objectives are similar, and now there won't be any exit tax, right? So there's one more amendment, so I'm just skipping it. Assessment and appeal. So this block assessment is now back. Though the memorandum has given sufficient reasoning for it, why they have done that, they have got a lot of feedback from the field officers that generally the assessment in the search cases used to take a good number of years, and during that period, either the officers get changed or there is an amendment in the income tax provision that used to create a lot of problems. So now they have reintroduced a block assessment, wherein the 6 years period will be considered as a block period, and whatever income is assessed would be taxable at the rate of 60%. All your pending assessment for that assessment year, which is being part of that block period, would be abated and would be taxable as per this provision. It would be taxable at the rate of 60%, plus there would be a penalty and the surcharge too. And there is an amendment in section 148A, which says now the assessment can be reopened after 3 years, but before 5 years, only if the escaped income is rupees 50 lakh or more. So I'll have just little time. So I'm just skipping the least important sections. Now the TDS and the TCS. So 194T. It was not our recommendation, but we expected that very soon the government will introduce the TDS on the salary of the remuneration, interest, and the bonus being paid by the partnership firm, and they have done it now. So if the the total payment in a year exceeds 20,000 rupees, there would be TDS obligation on the part of the partnership firm to deduct tax at the rate of 10%. The next point is they have included one more clause into 206C for the collection of the TCS in the case of purchase of the luxurious goods, and the value of those goods exceed 10 lakh rupees. What is a luxurious good? The government will notify the list of it. And again, this was expected. Why it is so? So we have got a provision which requires you to mention your PAN number if you are getting into a financial transaction of about 2 lakh rupees, even if you're buying any luxury good. But there was no subsequent reporting of that transaction in the SFT. So it was expected either they could introduce it in the SFT, wherein they're requiring the seller to report those transactions above 2 lakh rupees in the SFT, but they have placed the limit, the threshold limit of 10 lakh rupees, and that can be done by way of collection of TCS. 190 for IA, I think that was much needed, wherein they've clarified it in the case of multiple transfer or the transferee, the total sum paid or payable to all the transferees or by the transferors shall be considered for the applicability of TDS under section 194 IA for the calculation of the threshold limit. One change in 193A, wherein they've included one security, and okay, this was one of our expectation, wherein if you have any taxes paid outside India and that was paid out of your income, it should be and you have claimed a credit of it, it should be considered as your income. And we expected that the government soon will make the necessary amendment wherein that portion of the tax deduction for which you have got the credit shall be considered as your taxable income, and they have done it now. One change in 194C, wherein they have excluded 194J1. The transaction which are subject to tax under section 194J1 will not be covered under 194C. So in case of a minor child wherein the tax was collected, now the parents can claim a credit of it. So some relaxation has been given from the prosecution. So if you fulfill your obligation before the end of the relevant quarter for which the TDS statement has been filed, then there would be lesser implication. The prosecution can be, you get the immunity from the prosecution. The TDS rate has been reduced for certain sections, and it was really needed because some of these sections really impact the small players, the small and medium enterprises, and reducing the tax rate will really help them in blocking lesser funds in the form of a TDS, and not just the small enterprises, but all the landlord owners, the landlords, and in case of some individuals too, they'll have lesser amount blocked in the form of TDS. In the case of gig workers, the amendment in section 194O will have very good implication, wherein instead of 1%, only 0.1% would be the TDS amount. That will really help a lot of gig workers, wherein how much amount they get, and reducing the tax rate will really give them some relief. 194F has been omitted. It was not relevant at all. Now coming to the next point, wherein yes, TDS credit can be now will be considered for the calculation of the total tax which your employer consider for the deduction of tax. That amount will be deducted. Now you can apply for 194Q and 206C1H lower TDS and TDS certificate. We have recommended it in the recommendation letter we have sent to the government. The next point, the interest rate is increased from 1% to 1.5%. Yes, there was a gap in the TDS, the interest rate were 1.5%, but in TCS it was 1%. Now it has been at par. It has been increased to 1.5%. Some change in the penalty provisions. Yeah, this is really important. So guys, there are a lot of tribunal judgments wherein the tribunal has confirmed upheld the levy of penalty on the taxpayers if he forgets to make a disclosure of the foreign assets or the beneficial holding in any asset in the Schedule FA. And this was really, really very painful. And I have seen many taxpayers, return filers, who forgot to make a disclosure of their forward holding in any asset outside India. And the why this problem generally arising, because there is no information available with the chartered accountant of such information of such assets in the AIS. And sometimes they forget that they have some assets outside India. I'll just give you an example. So one of my friend who is a pilot, he has got an insurance policy from a French insurance company, and this is something which his employer got it, and he was the beneficial owner, and he was not aware of it. And he was paying a portion of it out of his pocket, and it was mandatory for him to make a disclosure because amount was very huge, in few $1 million. So if he does not make the disclosure, there is a risk of penalty under this under this Black Money Act. So now what they have done, they have increased the limit from 5 lakh to 20 lakh rupees. So if the value of your total foreign asset is up to 20 lakh rupees, there won't be any obligation on you to make a disclosure in Schedule FA. Even if you have it and you don't disclose it, there won't be any penalty clause. But if it exceeds 20 lakh rupees, then yes, you'll have the obligation to make a disclosure in Schedule FA. And if you don't do that, there would be a risk of living penalty of 10 lakh rupees. I'm not saying up to 10 lakh rupees, that the flat penalty of 10 lakh rupees that will be levied on you, and that may not be levied, that shall be levied on you. So this is all. Yes, another point is the angel tax. So this is much awaited amendment which they have done, where they have abolished 56(2) VIIB, both for the resident and the non-resident shareholder. Now there won't be any tax liability, but that this provision will apply only in the case of fresh issue of shares. In the case of sale of shares by the existing shareholders by the company, the implication would remain same, but no more 56(2) VIIB implications. They have removed mentioning Aadhaar enrollment ID in any of the document. Now it's mandatory to mention the Aadhaar number. You can't mention Aadhaar enrollment ID. Equalization levy has been removed. And why they have done that? Because the government is moving towards Pillar 1 and Pillar 2. And this equalization levy does not go with Pillar 1 and Pillar 2 approach. So that's why they have removed it. The point, Section 230. And Section 230, so if a person domiciled in India is living in India, it's mandatory for him to obtain a tax certificate that he has no liability under the Income Tax Act. But now they have included one more, that is Black Money Act, wherein you need to get a confirmation that there is no tax liability pending against you under the Black Money Act. STT. So STT, there's a 60% increase in the STT rate, both for the option and the derivative trading. And this move has been done by the government to actually demotivate the youth specifically to trade in the derivatives. And why they have done that? We know there are a lot of information reports by the SEBI that 95% of the traders dealing in the future and options are losing money. So we expected, and rather we recommended that it may be that from non-speculative, it could be the speculative one, or they could make a disallowance to some extent of the losses from the derivative. So rather they have, rather than doing it that way, they have increased the security transaction tax. So that means the government will definitely increase more than 50% of their revenue from the security transaction, because 60% is the increase in the STT rate. So if I assume there would be sudden, decline in the derivative transaction, but I assume there would be at least 50% increase in revenue of the government. I know I've been very fast because there were a lot of slides and I have to cover every important amendment. And now I'll take a breath. I have 7-8 minutes before I hand over the session to Karishma. So if you have any query, you can quickly ask me. And I hope we'll have a specific sessions dealing with a lot of this amendments, some important amendments, specifically the capital gain and the buyback. I will have more sessions. So I'm sorry for running like a bullet train from the last 35-40 minutes and explaining each and every amendment.
Thanks very much, Naveen. And it was actually a wonderful session, and you were not running like quite fast. It was all very well explained and catered to. So, and the way of the presentation was also very useful. I am sure that all the participants and members would have enlightened with this discussion. So, so thanks for this, Naveen. It indeed was a wonderful session. And there are many questions which have come up during the session from various participants. So I'll pick. I'm trying to pick up the most relevant ones because of the paucity of time we have here. So and I'll request you to answer those questions, right? So so one is that how, in your view, the increased standard deduction in this budget 2024 impacts the disposable income and consumer spending for the consumers and industries at large.
It is very clear, sir. If there is an increase in the standard deduction, there is a reduction in your tax liability. So you'll have, I wouldn't say very handsome amount in your hand as a disposable income, but yes, for some people, this amount would be, good enough to, I don't know if they would make an investment in the stock market or they'll use it for consumption purposes. But yes,
Disposition, yeah.
it should increase, but it will not impact much.
Right. And so I'm maybe there were some questions which I know that you addressed during your session, but since they have come up during the session, so maybe for the benefit of the larger audience, I'll raise that again. Right. So second is that how will the removal of indexation benefit for long-term capital gains affects the individual and the real estate sector at large? So I know that you covered this, but
No,
still
sir,
I thought
I didn't cover it in much detail, and I think for next 2-3 minutes I should give to this question. So this is we did some calculation. We made a lot of combination and combination, and I'll cover both the situations. So let's say you bought a property, you have an ancestral property, which your parents bought it or your grandparents bought it before 2001. So now, before this budget, how we used to calculate the capital gain, we used to have the valuation report or the circle rate as on 1st April 2001. That position will remain same. You will still have the fair market value benefit as on 1st April 2001. So there is no change in at all. So now coming to the second aspect, which is the indexation benefit. So now let's take an example to understand the situation. So let's say you have a property which you bought it, let's say in 1 lakh rupees, and on 1st April 2001, the value of that property is 10 lakh rupees. And you have that property, let's say in Gurugram or Noida, where there has been a huge increase in the price of the property. And as on date, you sell it for 1 crore rupees. So you bought it for 1 lakh, the FMV is 10 lakh, and you sold it for 1 crore rupees. So now there is a long-term capital gain as per the new tax scheme is 90 lakh rupees. On 90 lakh rupees, you pay tax at the rate of 12.5%. And that will be how much? Approximately 10 lakh rupees, 12 lakh rupees. But earlier, how we used to do it? So we used to claim the indexation benefit, which is the 3.63 if I talk about the current year. So I used to multiply 3.63 with 10 lakh. Now my long-term, the cost of acquisition, indexed cost of acquisition would be 36 lakh 30,000 rupees, right? And if I reduce it from my 1 crore rupees, which is my sale consideration, how much amount will I get? Approximately 64 lakh rupees. On 64 lakh rupees, I would pay tax at the rate of 20%, right? So now you see in your situation, the tax liability has actually reduced, right? Vis-a-vis without claiming the indexation benefit, by reducing the tax rate by 7.5%, there is a substantial saving in the tax liability. But this situation will not be valid in every situation. Now let's talk about Delhi. You have bought a property 5 years back, let's say at 50 lakh rupees, and now you are selling it at 80 or 90 lakh rupees, let's say calculation purpose for 1 crore rupees. There is a long-term capital gain of 50 lakh rupees, right? Earlier, maybe you would be paying lesser taxes because of the indexation benefit, but now you will pay tax entirely on the entire long-term capital gain of 50 lakh rupees at the rate of 12.5%. So in every situation, you need to compute, you need to calculate before you give any guidance to your client. And I believe, and in fact, we would also be sending another recommendation letter to the government. They should be grandfathering provision in this amended section, because all the property which I have bought in the past year, or wherein I have given the advance money a couple of days back, I should have that benefit now. This is the first time wherein they have made the changes retrospectively and retroactively. They should have given the benefit of the grandfathering provision, but unfortunately they haven't done that. Let's see if they make the changes in the finance bill as passed by the Lok Sabha. Now, over to you, sir. Maybe we can have one more question.
Yeah. So another question. Thanks for this explaining it so well, Naveen. And the next question is, what is the capital gain tax on RSU and ESPP issued by foreign entity? So listed in US and not in India.
Sir, I think this is not connected to the budget, so we should skip
Right.
this. We'll take another question.
Right. And finance bill proposes that buyback proceeds would be taxable as dividend in the hands of recipient. So whether any intercorporate dividend out of buyback proceeds can be used to declare dividend and claim ATM deduction?
No, sir.
Okay.
Because this deemed dividend is taxable in the hands of the shareholder, right? And is the intercorporate dividend and this deemed dividend are two different things. It cannot be considered the same.
Understood. So thanks, Naveen, for answering the questions and taking the session. And I know that there are. I'm having a lot of more questions, but looking at the time constants we have,
We can still take one more question. I still have 3 minutes. I want to use my time completely.
Okay. Right. So the next question is there any change in the rebate under Section 87A, or is there any importance after change in slab rate? No.
Oh. So I know why people are asking it. Before 5th July, there was a different treatment of the 87A relief, but after 5th July, they have made some changes in the utility on the e-filing portal. Now people are not able to claim 87A relief from the special income, and this has been the talk of the town. Many professionals have written many articles in the LinkedIn post why it should be allowed, and we did some calculations. So believe me, all the big Junjunwalas and Damanis, they are getting 87A relief if their normal income is so this should not be the case. Anyways, and I remember ICI and FICCI has also given a representation to the department to reconsider this calculation and allow 87 relief from the special income.
Okay. Thanks, Naveen, for this and for this session. And now I would like to introduce the second moderator of our today's event, Anushri Garg, who will welcome our second speaker for the day, CA Karishma Malhan. So Anushri is a practicing chartered accountant. She is a partner with the firm Suraj Garg and Associates. She has been practicing since 9 years in the field of GST, service tax, statutory audits, and taxation. And she is also a certified ESG professional and aids in implementation of ESG in businesses. And in the past, she has also worked with the law firm Chir Amrit Legal LLP. And she's actively participated as a speaker and convener in various seminars conducted by ICAI, TCA, RTCA, etc. And she's also contributed articles for various professional journals and online forums like Taxman and others. So with this, I welcome you, Anushri, for the second session of the today's webinar. And over to you. Thanks, Anushri.
Thank you, Kapil sir. So after listening to the direct tax proposals of the budget from our revered speaker, let us move to the indirect tax proposals. So I, CA Anushri Garg, will be moderating the discussion on indirect tax proposals. And I thank Committee for Members in Industry and Business of ICI for giving me an opportunity to be the moderator for this session. So yesterday in the budget speech, GST was termed as a success of vast proportions by our Honorable Finance Minister. To throw light on these vast GST proposals and other indirect tax proposals, we have with us our learned speaker, C. Karishma Malhan. She is a chartered accountant with over 4 years of post-qualification experience, specializing in indirect taxation research, advisory, and GST compliance. For over 3 years, she has been a part of Taxman's indirect tax research and advisory team. Her expertise includes preparing detailed research reports on complex indirect tax matters and addressing complex advisory queries, including classification and transaction advisory. She has co-authored research papers and articles on challenging GST-related issues, such as analyzing outcomes from GST Council meetings, exploring GST implications in cryptocurrency transactions, and conducting in-depth analysis of annual union budgets. So over to you, Karishma, for the session.
Thank you so much, Anushri. Thank you so much, Kapil sir. Thanks, Naveen sir, for sharing wonderful insights on direct tax proposals from this year's budget. And thanks everyone for joining in for today's session. So in this part of the webinar, we'll be discussing about the indirect tax proposals from the union budget. So I'll just share my screen with you all. Yes, I hope the screen is visible to everyone.
Yes, it is visible.
Yes, thanks, Anushri. So, okay. So, this year's union budget has, introduced so many new provisions under the GST law, which are noteworthy and are affecting the taxpayer a lot. So, without further ado, I'll start with the most important amendment, which is introduced under the demand and recovery provisions under the GST law. That is, new section 74A has been inserted to provide a common mechanism and timelines for issuing demand and recovery notices under GST. So this provision is said to be applicable for the cases pertaining to financial year 24-25. So giving you a brief background about the adjudication process under GST. So the adjudication process, that is issuing demand notices by the proper officers, has been broadly categorized into two parts. First is, which is covered under section 73 currently. It covers the cases of bona fide, where the taxpayers are not intending to evade tax. So the proper officer issues demand notices under section 73 wherever there is bona fide cases. And in case where the taxpayer are intending to evade tax, that is fraud cases. In such cases, demand notices are issued under section 74 currently. Now, since the inception of the GST law, there have been a lot of show cause notices that has been issued under 73 particularly. And the very first step of this adjudication process is to determine, like the proper officer is required to determine that whether the particular case falls within the scope of section 73 or section 74. Now, there has been a lot of litigation going on whether a particular case pertain to section 73 or 74. Now, this very first step of adjudication has always been under litigation, be it, from the previous regime of indirect taxation or the current GST regime. This controversy around whether a particular case would be covered as fraud case or not is always, been a matter of litigation. Now, this new provision would cover these cases and provide relief at least to the tax authorities so that they can issue a single notice irrespective of whether a particular case would cover within the scope of fraud cases or the cases are bona fide. Now, what does new section 74A says? It says that the proper officer may serve notice to the person chargeable with the tax where it appears to him that any tax has not been paid, short paid, erroneously refunded, or ITC has been wrongly availed or utilized. So if we look at it closely, the drafting of the provision is very similar to section 73 and 74. So the basics of the provision remain the same. However, what is different from the previous provision is the time limit of issuing show cause notices and order. So earlier, the time limit of issuing notices under section 73, that is bona fide cases, was 2 years and 9 months from the due date of annual return. And under Section 74, the time limit was 4 years and 6 months from the due date of furnishing annual return. Now, under new Section 74A, the time limit to issue show cause notice would be 42 months from the due date of furnishing the annual return. And in case of erroneous refund, it would be 42 months from the date of erroneous refund wrongly availed and utilized. Okay, so the time limit of issuing the order under new Section 74 would be considered from 12 months from the date of notice. So earlier, the time limit of issuing notices was dependent upon the time limit of issuing order. However, in this new provision, the time limit of issuing order is dependent upon the time limit of issuing notices. And one more important insertion has been made in Section 74A, which should be, which will be having a very significant over the impact over the industry, is that the commissioner has been given a power to extend the timeline of issuing orders under Section 74A by maximum of up to 6 months. So as per the previous provision, there was no power given to any commissioner to extend the timeline. Only, a cover was there under Section 168A, which was used during the COVID pandemic period, that where the time limits of Section 73 particularly for financial year 17, 18, 19 were extended due to COVID pandemic. But now they have incorporated within itself, the Section 74A within itself gives the power to the commissioner to further extend the time limit of issuing order. So that was something to be noted in this section. And earlier there was relaxation provided to the taxpayer, that where before 30 days of issuing of notice or the orders, if the taxpayer comes up and say, okay, I'm paying the tax liability along with the applicable interest, then the provision used to say for both Section 74 and 70C that either no penalty would be required to be paid in bona fide cases, or reduced penalty would be
So, Karishma is just checking the connection at her end.
Yeah, I also couldn't hear Karishma.
The person you have called is
am I audible to you? Hello.
Yes, you are
Karishma.
audible.
yes, ma'am. Yes, ma'am.
Your video is yet to appear.
Yes, okay. So just give me a moment. I'm sorry for that disturbance.
No problem, no problem. We just
That's
missed
No
the
problem,
last
ma'am.
few minutes, right?
Okay, so is it visible now?
The PPT is visible. Your video is yet to come.
Okay.
Participants can send their questions if they have feedback.
Okay, I think now it
We'll
must
take
be
them at the
fine.
end of the session. Yes, your video is fine now. You can continue.
Yes, sorry.
No
Yes.
problem.
So I was saying that earlier the time limit, earlier where the taxpayers were paying tax amount and along with the interest within the 30 days of issuance of notice or order, they were given the penalty or no penalty under relevant section 73 and 74. Now, this a new section 74A would provide 60 days time limit, as you can see it on your screens. So these time limit would be have been extended to 60 days, and lower penalty benefit would be still available to the taxpayers. Now, these penalty provisions will also remain the same as they existed under section 73 and 74, and no further notice under section 74A would be issued if the amount involved is less than 1,000 rupees. So this is something new which has been inserted under section 74A to reduce the litigation on small amount matters. So that is something new. And yes, section 74A has been inserted for the issues which are pertaining to financial year 2024-25 onwards, and it will previous section 73 and 74 would remain applicable for the cases pertaining to financial year 23-24 only. So up to financial 23-24, the old provision would remain, and for after 24 and 25, new section 74A would be followed. And corresponding to this new provision, corresponding amendment has also been made under relevant provision wherever reference of section 73 and 74 was there. So now coming on to the next important amendment which has been proposed by the budget, it is insertion of section 128A, and this will be providing a waiver of interest and penalty for demand notices under section 73. So this particular waiver would be applicable only for the period between 1st July, that is from the inception of GST, till 31st March 2020. So, since the inception of GST, there were so many open issues which existed under the GST law. Be it, cases related to whether GST is liable to be paid on a particular supply, whether, what classification of a particular product would be followed, whether ITC is available on a particular transaction or not. So during the initial years, even the basic provision in respect of some transactions remained unclear. It is just in the recent years that the government has, recently issued so many clarification and amendment under the GST law, due to which we could get the clarity in respect of certain goods and services, that certain applicability of ITC provisions. In fact, there are so many provisions which are yet to be clarified by the government. But, particularly for this period till 2020, there were so many issues which were under litigation. And of course, as I said previously, that the time limit of issuing notices and order under section 73 has been extended multiple times, specifically for the period of 17, 18, 18, 19, be it due to COVID pandemic. But the amount has been extended, but the time period has been extended, and the amount of interest and penalty involved in these cases have been increased in some cases, that they have exceeded the amount of tax involved in a particular dispute. So this waiver, this new section 128A is a very welcome move by the government. And although it is a little complicated, its applicability is a little complicated, but let's try to decode it in a very simple words. all these cases
Recording in
would fall within
progress.
the scope of 128A. And the next point is that where a notice was issued under Section 73 earlier, but later on at the appellate authority level or at the tribunal or court level, it has been held that the case was not of the case of Section 74. The taxpayer was not doing any evasion of tax due to the fraudulent intention, but it should have been covered under Section 73. So a relief has been provided to those taxpayers also by way of amending Section 75. And so I think there were a lot of questions which were raised while the GST Council recommendation came on this particular provision. So I think this amendment is clearly covering those cases also where earlier the notices were issued under fraud, but later on they were considered, later on the intention was considered non-fraudulent. Okay, so now what are the cases where this particular new provision would not apply? So as also recommended by the GST Council meeting, these provision will not apply to the amount payable due to erroneous refund. And this waiver would also not be available where appeal is pending before the appellate authority and the tribunal and has not been withdrawn. So all those taxpayers, who have received the orders from either from the appellate authority and have filed their writ petition before the court, or where the commissioner has passed an order for demand order, where the proper officer has passed a demand order in the Section 73, and they have filed their appeal before the appellate authority and it is still pending, then they will have to withdraw these applications and then only they'll be able to get the benefit under Section 128A. Okay, so the next point is where the application is filed by the department. So under Section 107 or 112 or with High Court or Supreme Court. So if department opts to go for an appeal for a particular issue where order has been passed, so and this particular appellate level comes up with a further additional amount of demand for the taxpayer. Now the taxpayer will have to pay that additional amount within the 3 months from the date of the order passed by the relevant authority. So yes, so apart from whatever which is paid by the taxpayer, the full amount of tax which is paid by the taxpayer, he will also have to pay the additional amount within 3 months. Also, where benefit of 128A has been availed, this taxpayer cannot further file an appeal for this order of demand. Okay, and finally, the most important point, that where the interest and penalty has already been paid by the taxpayer, no refund would be granted. So this was a very much there was a very much need of clarity on this particular point, and the provision itself is very clear that no refund would be granted where taxpayers have already paid the interest and penalty amount. Now coming on to the GST levy provisions, Section 9 has been amended, to allow. Just give me a second. Yes, the taxpayers. Sorry, Section 9 has been amended in the CGST Act to exclude the extra neutral alcohol used for the manufacturing of alcohol liquid for human consumption. So this point was also recommended by the 52nd and 53rd GST Council, and the same has been implemented in this budget. And yes, the ENA which is used for the industrial purposes will still remain to be taxable under the GST law. Now another important section, Section 11A, which has been inserted under the GST law, which is empowering the government to regularize the non-levy or short levy of GST, where tax was being short paid or not paid due to general trade practices prevalent in trade. So recent trend has shown, specifically since the 49th GST Council meeting, the CBIC has been issuing circular to regularize the GST levy, GST liability and exemptions on certain goods and services. Let's take an example of the 53rd GST Council meeting itself. So the exemption on reinsurance services and the exemption on services provided by Ministry of Railways have been regularized on as is where is basis. So these clarifications have been issued in the past 2 years, and on certain goods and services classification as well as exemption. So earlier there was no governing provision under the GST law to allow the government to regularize GST liability on certain goods and services through by way of issuing a clarification only under the GST law. Now this particular provision which has been inserted, it will empower the government to issue similar kind of circulars and to regularize tax liability or exemption. uh, we can say that it is a very positive provision, as it is providing extended exemptions and short levy benefit to the cases where the general trade practices is not to pay GST. But yes, one important point in this provision is, as per our view, ITC cases, the litigation which is due on ITC cases should not be covered in this provision. As this provision is only talking about non-levy and short levy of GST. So yeah, ITC provisions are not specifically covered under this provision. Now moving on to Schedule 3, there are two insertions relating to insurance sector in Schedule 3 of the CGST Act. So co-insurance agreement. In co-insurance agreement, there are multiple insurers which come together and provide a single insurance policy to the policyholders. So one out of all these co-insurers, there is one insurer called lead insurers who take undertake all the administrative work, and he collects the premium from the policy holders and then apportion all these premiums to the co-insurance co-insurance companies. So earlier there was a lot of representation made before the government that whether this apportionment amount should also be liable to GST, because the person who is working as a lead insurer has already been paying GST on the premium which is collected from the policy holders. So a big relief has been provided in this case, and no GST would be payable on such apportionment of co-insurance premium by lead insurance to the co-insured insurance companies. And similar to the co-insurance agreement, benefit has also been provided to reinsurance transactions. So in this case, basically the primary insurer is passing on the commission to the other reinsurance companies. So in that case, this commission amount would now not be chargeable to GST, and it will be covered within the scope of Schedule 3. Now moving on to the ITC part, which is again very important from the perspective of this year's union budget. For financial year 17-18, 18-19, 19-20, and 20-21. So for all these financial year, the government has provided such a big relief to the taxpayer that any ITC which has been availed by the tax period availed by the taxpayers for these period in a return which is filed up to 31st November 2021, they'll be eligible to avail this ITC irrespective of the time limit which is given under section 16(4). So during these 4 years, the time limit was 30th September, to which the invoices and debit note pertain. So now the taxpayers can, could avail this ITC if if they have filed the return up to the date of 30th November 2021. So, there were a lot of taxpayers who could not file the returns for these particular financial years within the time limit. and they were availing the ITC beyond the time limit which is provided under Section 16(4). So a huge relief to all these taxpayers who have not availed the ITC as per Section 16(4). However, Section 146 of the Finance Bill is not providing any refund relief to those taxpayers who have already paid the GST when the time limit exceeded, or they have either reversed the ITC, or they had to pay the tax when the ITC was availed after the time limits of 16(4). So this Section 146 has been particularly provided to not to grant any benefit to the taxpayers who have already paid the tax. So talking about the three sections, Section 128A, Section 11A, and this Section 16(5). All these three provision are prima facie providing the benefit to the taxpayer who could not comply with the GST provision in time. However, no benefit under these three provisions has been given and will be given to the taxpayer who had complied properly with the GST provision. So this is a very important point which should be noted by the taxpayer, that whether to comply with the GST provision in time or not. Now, the second provision which has been inserted under Section 16 is in relation to, where the taxpayer's registration has been cancelled and later on revoked based on the application of revocation filed by the taxpayers. So wherever the time limit of 16(4) has been lapsed and thereafter the GST registration has been revived after this said time limit, now the 30 days time limit would be given to such taxpayers to claim the ITC in the return which they will be required to file in terms of Section 30 of the CGST Act. Now, in line with the insertion of Section 74A, simultaneous amendment has been made under Section 17(5) that Section 17(5) earlier restricted the ITC in respect of the tax paid under Section 74. So now, since Section 74 will be applicable only to the matters pertaining to financial year 23-24, so now this section has also been correspondingly amended to have its effect only up to financial year 23-24. Also, clarificatory amendment has been made under Section 17(5) to remove the implication of Sections 129 and 130 from its scope. Another point which is related to transitional credit particularly. So the Section 147 of the CGST Act provided benefit to to the ISD, that for the services which they have received prior to the appointed date, but the invoices for such receipts have been received after the appointed date, the provision clearly provided that ISD can distribute such ITC on such invoices. However, there was no particular provision for distribution of ITC relating to those services for which invoices were received prior to the appointed date. So now this clarificatory, or in fact amendment has been made under the law to allow those ISD who are receiving invoices for the period prior to the appointed date, they can also distribute the ITC to different branches. Now, moving on to the provision relating to the issuance of invoices and time of supply. So, in respect of RCM supplies, the time of supply of services is date of payment as entered into the books of recipient, date on which the payment is debited in the recipient's bank account, or 60 days immediately following the date of the invoice issued by the supplier. Now, this particular provision which pertains to RCM, reverse charge supplies, does not talk about the time of supply where the invoices or the self invoices as per Section 31(3)(f) has been issued by the unregistered persons. Sorry, has been issued by the registered persons who are receiving the supplies which are liable to RCM. So now a specific provision has been inserted under section 31(3), which will provide a time limit for issuing self invoices, uh, provide and further corresponding amendment has been made under time of supply provision to consider the date of issuance of invoices by the recipient as the time of supply. And yes, the time limit for issuance of invoices would be provided separately under the CGST rules. Now, one provision is relating to anti-profiteering, which has been amended. So, anti-profiteering provision was inserted under the GST law to pass on the benefit of rate reduction due to the implementation of GST to the customers. So, this provision's objective is prima facie to reduce the effect of reduction in price on the inflation. So, this concept has been borrowed from the overseas indirect taxation laws, where these provisions have already been adopted and have been followed for a specified period of time once the new law gets settled. So since GST law is at the stage where we can say that okay, the implementation of the GST law can be said to be settled. So now, as per the recommendation of the 53rd GST Council meeting, the section 171 would provide that a power would be given to the government to insert a sunset clause on the anti-profiteering provision. Although the date of this particular sunset clause is yet to be notified, however, the clause has been inserted. Relevant provision has been inserted under section 177. Another point which is relating to anti-profiteering provision is that earlier Competition Commission of India was taking up cases relating to anti-profiteering, and they were currently handling all the cases relating to this particular provision. Now, all these cases would be forwarded to the appellate tribunal for taking up anti-profiteering provision. So, simultaneous amendment has also been made under GST 80 provision, where appellate tribunal has been given power to take up these cases. Now, other relevant provisions which have been amended under the GST law are section 39, and particularly in relation to TDS returns. So earlier, the provision for filing returns provided that the TDS deductor would be liable to file the return only in months in which the deduction has been made by the deductor. No provision was there to file nil return. So now, based on the recommendation of 53rd GST Council meeting, this provision has been amended, and now TDS deductors would be required to file a monthly return. And if there is no deduction made during that particular month, then they can file the nil returns. Now, next provision relates to refund on exports. So, Section 54(3) of the CGST Act specifically covers the cases of refund of unutilized input tax credit. So, second proviso to Section 54(3) says that provides a restriction of refund, that refund of unutilized ITC cannot be availed where the goods are subjected to export duty. Now, there were few taxpayers who were, filing representation whether they can file refund of in such cases based on, IGST payment mode instead of opting for LUT mode. So now, this second proviso to Section 54(3) has been omitted, and a separate provision has been inserted to restrict refund in case of zero-rated supplies of goods which are subject to export duty, be it the case of unutilized ITC, that is LUT mode, or with payment of IGST mode. So in both these cases, refund cannot be claimed if the goods are subject to export duty. Okay, next point is also based on the recommendation of the 53rd GST Council meeting. This is reduction in the amount of pre-deposit. So this amendment has been reduced you know for providing relief to the taxpayers so that they can manage their working capital better. So existing provision provided the cap of 25 crores of CGST, SGST, which was payable, which was required to be paid as a pre-deposit at the level of appellate authority. Now this amount has been decreased to 20 crores CGST, SGST each, and the appellate tribunal at this level, the amount was earlier 20% of the disputed amount, and a cap of 50 crores was there for CGST, SGST each. Now this both these amounts have been decreased, and 10% of the disputed amount would be required to be payable, and 20 crores would be payable for CGST and SGST. So this is also a very important and significant amendment for the taxpayer who are opting for filing appeal before appellate tribunal level. So now pre-deposit amount has been reduced significantly. Now another provision, this I think I have already discussed, that anti-profiteering provisions would be passed on to the appellate tribunal level. However, the principal bench has been assigned as the bench who will take up the cases of anti-profiteering provision. And in fact, a separate provision has been inserted for the government to notify any other cases which shall be heard only by the principal bench. Now, the next point is section 122, which is relating to the penalty provisions. Now, penalty with effect from 1st October 2023, e-commerce operators were required. Please give me a moment. Yes. With effect from 1st October 2023, the taxpayers such as unregistered taxpayers and composition dealers were allowed to, make transactions through e-commerce operators without taking normal registration under the GST law. So e-commerce operator in this respect was required to follow a particular procedure. That is, he has to ensure that proper enrollment number has been given to all these taxpayers, and through that they were, undergoing transactions through the e-commerce operator. So now, where these e-commerce operators are not complying with the provisions of the special procedure which has been specifically notified, then in that case, with effect from 1st October 2023 again, this penalty provision was inserted. However, this penalty provision did not specifically provided that the e-commerce who are required to collect TCS would be covered. So now this clarificatory amendment has been made in section 122(1)(b) to allow only to cover only those e-commerce operators, who are required to collect tax at source, that is TCS under section 52. And next is related to section 70. And this is wherever proper officer issue any summon to a taxpayer, he is required to present himself before the proper officer, and he has to produce the required documents and information. Now, amendment has been made under section 70 to allow the authorized representatives also who can appear on behalf of the person who has been summoned under section 70. Okay, so another point which is related to appellate tribunal is that appellate tribunal, the time limit of filing appeal before the appellate tribunal is 3 months from the date of order, which is passed by the appellate authority level. So I think by way of removal of difficulty order, this time limit was extended, and it was said that 3 months would be counted from the date from which president would take his seat. So since the GST appellate tribunal is still not operational, an amendment has been made under the relevant section to allow, further time period to the taxpayers and the department to file appeal before the appellate tribunal. And this date has not yet been notified, but it will be sooner notified by the government. Now, other amendments. Now, let's start with the customs amendments. We'll cover very briefly these amendments, and yes, then we can start with the questions. So, Section 28 DA has been amended to provide that the importer can submit the proof of origin instead of certificate of origin. So what does Section 28 DA says? So Section 28 DA is particularly about the importer who can claim preferential rate of duty on imported goods if they qualify as originating goods from a particular country. So for claiming the benefit of preferential rate of duty, the importers are required to submit the certificate of origin currently. Now, this phrase has been changed and substituted. Now, the proof of origin would be accepted instead of certificate of origin. What does proof of origin means? So this has also been specifically inserted by the budget, that the proof of origin would include any self certification which is furnished by the importer, and instead of getting a certificate from the relevant authority, he can submit his own self certification to show that, okay, I've imported these goods from a particular country. In the excise, there is an important update, is that clean environment cess, which was basically introduced to reduce the coal consumption and associated carbon emissions. So this was initially implemented in order to adapt the climate change and combat climate change and promote environment conservation. Now, after GST, after the implementation of the GST, clean environmental cess was subsumed under the GST compensation cess. So, clean environmental cess amendment has been made under the relevant excise law, that this will be exempted with effect from 30th June 2017, subject to a condition that GST compensation cess has been paid on or after the applicability of GST. So yes, I think this is it from my side. I hope I was able to share a couple of important updates with you. So I think we can move on to the questions now.
Yes, so thank you, Karishma. That was a wonderful deliberation from your side. And
Thank you.
the questions we can take now. So one of the questions is, what are the potential benefits and challenges for different sectors arising from the proposed power to regularize non-levy or short levy of GST? This is in view of the proposed Section 74A.
Okay. So, as I said that initially Section 73 and 74 were introduced under the law, and different time limits were provided. Like 3 years time limit was provided under Section 73, and 5 years timeline was provided under 74. So now this new timeline of 42 months is working as a mediator between the department and the taxpayers. So this time limit has not been, like when the GST Council recommendation came, everyone was thinking that how much time period will be determined for a common provision. So one was saying that, okay, department may extend it even further, or they may reduce it. There was no chance of reducing it, but definitely there was a chance of increasing the time limit. So now there is a midway time limit has been prescribed under the law. So I think this would work not only for the benefit of the government, but might work for the benefit of the taxpayer, with the time limit is with respect to the fraudulent cases. Yes.
All right. So moving on to the next question. So how do industry experts compare this budget regarding indirect tax proposals to their expectations? And are there any areas where you think further action is needed, or there was some expectation but that has not been addressed by the budget?
Okay, so see, the budget in terms of the GST law is generally, predetermined based on the recommendation of the GST Council. So once the GST Council recommendation come, we can directly conclude that okay, these are the provisions which can be implemented through the budget, and these are the provisions which will be implemented through a notification. So I think we all were expecting that these provisions would definitely come through the budget since recently the GST 53rd GST Council meeting was held. However, there were so many other provisions which could be, tackled by the government, which could have been addressed by the government, but still, even in this year, these provisions are yet to be properly prescribed by the law, be it taxability, of the online money gaming, be it the taxability of uh, cryptocurrencies, be it giving a clear picture on the taxability of different, uh, classification issues which are still long pending before the taxpayer. So yes, a few of these recommendations by the council meeting related to corporate guarantee was very welcome, and ISD implementation was also very welcoming. But yes, still there are a lot of issues which are required to be addressed by the government, which for which the list can go on and on, since there are so many controversy that still exist under the GST law.
So another question is, are there concerns about the administrative complexity of implementing the announced changes? Because see, LPC is the backbone of GST, and regarding the changes in Section 15 that have come, so they've clearly specified that there will be no refund available for the ITC already reversed. So how do you see it as a challenge?
So see, I already mentioned that three relief kind of provision have been inserted under the GST law. The three of these provisions are, denying the benefit to the taxpayers who are uh, regularly complying with the GST provision. No benefit has been extended to the taxpayers who are regularly working as per the relevant provision. Take an example, 16.4. There were so many taxpayers who were actually following the timelines, and they had properly reversed the ITC on once the time limit of 16.4 lapsed. So if the government is moving towards, allowing the benefit to the taxpayer who have not actually complied with the provision, I think there is a really need to revisit, because this kind of provisions, this kind of amendment are giving a view that whether even a taxpayer should go ahead with complying with the provision, or and he will keep on he can wait for the amnesty scheme, next amnesty scheme which will come under the GST law for such taxpayer, whereas the person who is complying with the GST law is not given any benefit under the law. So definitely there is a very big challenge for such kind of taxpayers to, they are, since they are given no benefit.
And how does the amnesty scheme that has come in GST, do you, what advice will you give to, the fellow chartered accountants that they should give to their clients in advance to avail maximum benefit of the scheme?
Okay, so in the past year, I think there are so many amnesty schemes which have been provided by the government, be it like, a time limit for filing appeals before the appellate authority. The time limit has been extended. Be it like the new insertion of Section 128A. So I think uh, taxpayers can ensure that, okay, uh, they should comply with the as per the GST law, but wherever they are, not complying with the GST provision, or they have missed any particular due date or any return, I think since the government is coming up with multiple amnesty schemes, some I have heard somewhere that people are saying that, taxpayers can always wait for the next amnesty scheme and they can not comply with the GST law. But you never know how the government would take its next step. Last year has been a very positive, but you never know how the government will be working in its next budget. So still, the professionals, the chartered accountants can take a view that, okay, wherever there is a possibility for taking an aggressive approach on a particular issue, I think they can wait for the clarification of the department, and wherever there is a need for taking a lenient view, and wherever there is a need to take a conservative approach, then that should be followed. Hello. Yes, Anushri.
It says, how do the rate changes in customs? Yes.
Sorry, I lost your
So
voice.
another
Yes.
question is from customs.
Okay. Hello. Anushri, can you hear me? Okay.
Yes. So sorry, maybe there was some connection issue at my
No
end.
problem.
So
No
last
problem.
question from the customs. It says the rate changes in customs, how do they affect the industry, and do they initiate demand creation in any of the industry?
Okay, so under the, I think, custom tariff, they have issued a list of goods and services on which the tax, the DCD and custom duty has been reduced, specifically relating to the agricultural sector and marine sector. The GST amount has been, the custom duty amount has been reduced, and whereas there were some other products on which relating to steel sector, I guess, where the BCD amount was increased substantially. So yes, based on the sector to which the goods pertain, I think the impact would always be there wherever there is a change in BCD and duties. So yeah, based on the sector, based on the industry, there will always be an impact. Yes.
So those are all the questions till now.
Okay, thank
So
you,
with this,
Anushri.
we come to an end of discussion. Welcome. So with this, we come to an end of discussion on the budget proposals. It was a wonderful deliberation by CA Karishma Malan, making us well conversant with the IDT proposals and also giving us food for thought over various ITC and other issues. Next, I would like to extend my heartfelt thanks to both the distinguished speakers for enlightening us with the budget proposals. I also thank CA Kapil Kedar for initiating and moderating the webinar. I'm also grateful to committee for members in industry of ICI, members in industry and business of ICI, CA Dheeraj Khandelwal, Chairman CMINB, and CA Sanjeev Singhal, Vice Chairman CMINB ICI, for organizing this webinar and providing me the privilege to moderate this wonderful learning session. Last but not the least, I would like to thank the organizing committee of ICI for the successful conduct of this webinar. So over to the ICI committee for the end of this webinar.
I thank everyone for joining, and thank you, Karishma ma'am, thank you, Nishri ma'am, thank you, Kedar sir, thank you, everyone. Yes, please.
Recording stopped.